I think stocks are a perfectly decent way to make 6 or 7% a year over the next 15 or 20 years. But I think anybody that expects to make 15% per year or expects their broker or investment advisor to make that kind of money is living in a dream world. And it's particularly interesting to me that back when the prospects for stocks were far better, I even wrote something about this in the late 70s, pension funds were using investment rate assumptions that were often in the 6% or thereabout range. And now when the prospects are way poor, most pension funds are building into their calculations returns of 9% or better on investments. I don't know how they're going to get 9% or better on investments, but I also know that if they change the investment assumption down, it will change the charge to earnings substantially, and they don't want to do that.
Pension fund accounting is drifting into scandal by making these unreasonable investment assumptions. It's evidently just part of the human condition that people extrapolate the recent past. And so since returns from common stocks have been high for quite a long period, they extrapolate that they will continue to be very high into the future. And that creates a lot of reported earnings in terms of pension benefits that aren't available in cash and are likely not to be available at all. And this is not a good idea. And it's interesting how few corporate managements have just responded like Sam Goldwyn, include me out. You'd think more people would just say, this is a scummy way to keep the books, and I will not participate. And instead, everybody just drifts along with the tide, assisted by all these wonderful consultants.